Welcome everybody to our first quarter of 2022, our economic update. Bob and I will share with you a little bit of the past and where we see things today and going forward. Our agenda today will be discussing our investment strategies and our decision making, a little bit on our historical performance, and talk about the domestic stock market as it pertains to the US dollar and some things with the global economy and bond yields. Bob?
Thank you, John. So we've had some pretty aggressive allocations over the last year. In particular, we've completely divested or repatriated all money into US. We'll explain a little bit of that later in the US dollar, but really there's two reasons for that. Primarily that the US economy is stronger and growing at a better pace. That a large part of that has to do with we have our own central bank. And another piece of that is that the dollar continues to strengthen as world markets react to COVID. People are continuing to put their money into the US dollar.
This next chart wanted to talk a little bit about our historical performance over the last 3 years and how that relates to the indexes of the asset allocations that we're targeting to manage. And most people have a benchmark of a rate of return plus inflation that we're trying to achieve to get their financial planning goals. What you can see here at the top is our base model performances for month, quarter, year to date, 1 year, and 3 year. You can see right beneath that what the global indexes have been for those same time periods. So you can compare that to how we've done. To the right of the top section highlighted in yellow shows the alpha that we've generated over and above, which is the return over and above the index asset allocation targets. So our system has worked very well, and we've been able to achieve outsized returns for the given level of risk level that you guys are at today. So we're very pleased with the way the performance has worked out, and thank Bob a lot for adding a lot of value to our investment process.
Yeah, it's really been an interesting couple of years since COVID broke in early 2020. The way I would typify it is a lot of volatility. We've had very good returns, but there's been some serious significant pullbacks along the way. So the biggest game, the most important thing we've been able to do is stay invested during this period. Really, if you look at what did well last year, it was being invested, but really the only people that really got hurt were people that were overly conservative, oddly enough, people that were either overly concentrated in fixed income securities or even worse, all in cash. So there is kind of this magical thing that happens at the end of the year where we hit a reset button. We think about stocks are now up 0% for the year. Bond rates are neither higher nor lower. Dollars neither strengthen nor weaken. But really, even though we do these year-end pieces, the economy is no different on January 1st than it was on December 31st. And a lot of our thinking going into 2022 is similar to our thinking of 2021. We don't see major pivot points ahead during 2022, at least not for the first 6 months. So here's a chart that shows us what the individual countries have done as far as return. We can see that the US has led all countries, has for the last several years, and continues to. And like we said, the reasoning for that is really twofold. One, the actual local market return has been higher. So the US stock market return has been higher than these other countries. But a second very important piece of that is that the US dollar continues to strengthen. People keep, especially during these times of turmoil, they view the dollar as a safe haven, as the safe haven currency. People keep moving money into US dollars. If you're a US investor investing internationally, that means that what you're investing in is not only returning less than the US in local terms, it's also losing value because that currency is depreciating against the dollar. There's the US dollar index. We can see how much it continues to strengthen. We don't expect this trend to turn around anytime soon. A lot of times people say, well, the U.S. is creating such deficit issues, and that why isn't the dollar weakening? Well, as wide as our deficits have become, international central banks are creating even more debt and deficits. So it's an all relative game. The U.S. dollar is continuing to strengthen against all foreign currencies at this time. As we said here, U.S. dollar, our debt to GDP ratio is incredibly high, almost 170%. But then, we look at, for example, a place like Japan, you can see why we continue to appreciate against the yen. Theirs is about 220%. So, as much as deficit spending does weaken a currency, that is traditional economic theory and thought. It is true, but in order for a currency to weaken, another currency has to strengthen. And in this case, it's not that the U.S. isn't doing a lot of deficit spending, it's that other countries like Japan are simply doing more. This is probably the one market that has hurt the most investors over time, or investment careers certainly over time. People have been calling for higher interest rates for a long time. We understand why. We're sympathetic to the reason why. Typically, 10-year bond yields will trade about 3% over inflation. Right now, they're trading lower than the inflation rate. That continues to be an issue with our Federal Reserve is buying an enormous amount of government bonds. Now, they're supposed to taper that. They have started to taper that. They're buying $120 billion a month. They've tapered that back to $90 billion a month and are going to continue to buy less. As they do, we do expect bond yields to rise, but not as much as traditional economic models would suggest. And the reason is pretty simple. It's all a relative gain. US bond yields are much too low given the rate of inflation. The problem is this. If you're a German investor, would you want to invest in a negative yield and earn a negative return on your money, or a Japanese investor and effectively earn zero? US bonds are still attracting an enormous amount of foreign buyers. It's really the only place in the world where you can get meaningful returns on a very safe asset. And so despite inflation being higher here in the US, and the thought that our bond yield should be higher, especially as our Federal Reserve stopped purchasing as many bonds, we really don't think bond yields are going to be able to raise much above maybe 2%, maybe 2.5% during 2022, but we're not expecting the big sell-off of bonds that everybody's been predicting.
With that, Bob and I and the entire MMFS team would like to wish all of you a very happy new year, and we look forward to hopefully seeing you all in person very soon. Thank you.
Happy New Year, everyone.